My name is Lee Reiners, and I'm the Policy Director at the Duke Financial Economics Center and a lecturing fellow at Duke University School of Law. At Duke, I teach courses in cryptocurrency law and financial regulation. And prior to entering academia, I spent 5 years examining systemically important financial institutions at the Federal Reserve Bank of New York. Satoshi Nakamoto introduced the first cryptocurrency, Bitcoin, to the world in a 9-page white paper posted on Halloween 2008. And the first Bitcoin transaction occurred in January 2009. 14 years, thousands of cryptocurrencies, and trillions of investor losses later, crypto scarcely resembles the purely peer-to-peer version of electronic cash first envisioned by Satoshi. By technology standards, crypto is not new. For comparison, the iPhone was introduced in 2007. More recently, OpenAI made the artificial intelligence chatbot, ChatGPT, available to the public last November. 2 months later, ChatGPT had 100 million monthly active users, making it the fastest growing consumer application in history. After 14 years and countless claims that crypto represents the future of money, finance, or something else, we have yet to see crypto's killer use case. In fact, only 16% of US adults have invested in, traded, or used crypto. The data is clear. Most people invested in crypto simply because they thought they could sell it to someone else at a higher price in the future. Sadly, these people were wrong. 14 years have provided ample evidence of the dire harm cryptocurrency inflicts throughout our society. Beyond the billions in investor losses due to frauds, hacks, and scams, crypto undermines our national security by facilitating terrorist financing and sanctions evasion. It undermines our economic security by fueling a surge in ransomware attacks that have crippled American businesses, healthcare systems, and municipal governments. And it jeopardizes our climate goals by needlessly consuming massive amounts of energy that contribute to carbon emissions and electronic waste. I ask, what benefits do we have to show for these costs? Even as we stand in the ashes of the FTX implosion, the crypto industry is spinning new narratives to deflect and obfuscate the damage they have wrought. One such line goes that Sam Bankman-Fried was just a bad apple, and that the problem lies not with crypto's underlying technology, but with centralized crypto intermediaries. But FTX was not an isolated incident. Terra Luna, Celsius, Voyager, BlockFi, Axie Infinity, Genesis, Mango Markets. How many more must fail before we conclude that the entire barrel is rotten? Another self-serving line spun by crypto boosters is that policymakers must embrace innovation, or else the crypto industry will migrate to other jurisdictions with a more favorable regulatory climate. But this implies that innovation is an unmitigated good. The truth is that innovation is value neutral. It can be used for good or bad. Instagram for kids is technically innovative, but does anyone think it's a good idea? Looking at crypto, it is clear that the costs outweigh the benefits. So why would we want to embrace it? The millions of Americans who invested in crypto only to see their hard-earned money evaporate do not care whether crypto is classified as a commodity or a security. They do not care whether the industry is regulated by the SEC, CFTC, or some other agency. They only care about having the same basic safeguards they have come to know and expect from the traditional financial system. Unfortunately, we have let them down. The time has come for action that only Congress can provide. While I agree with SEC Chairman Gary Gensler that most cryptocurrencies are securities subject to SEC registration and disclosure requirements, some cryptocurrencies, like Bitcoin, are commodities. While the CFTC regulates commodity derivatives, they do not regulate commodity spot markets. The practical effect of this structure is that cryptocurrency exchanges in the US are presently not regulated at the federal level. In my written testimony, I provide a detailed roadmap for how Congress can close this gap. I urge Congress to carve out cryptocurrency from the definition of commodity in the Commodity Exchange Act and recognize cryptocurrencies as securities under a special definition to the securities laws. This would give the SEC exclusive authority to regulate all aspects of the crypto industry. The SEC simply has more expertise, more resources, and more appetite for enforcement in the crypto realm than the CFTC does. Most importantly, unlike the CFTC, the SEC has a statutory mandate to protect investors. Whatever Congress decides to do, the status quo is simply untenable.
As Senator Menendez said, the fact that this could become a tool in America's foreign policy and economic arsenal.
Yeah, thank you for that question, Senator. So I'll respond by saying that crypto is not new. The first Bitcoin transaction was in 2009. So we have a 14-year track record to look back and assess this. And it didn't take the internet 14 years to prove its worth. And so when you look at cryptocurrencies, I would just ask, what's the fundamental value? Why are they worth anything? Normal financial assets are someone else's liability, right? There's an issuer. Otherwise, where would the returns come from? So there's no reason to think that cryptocurrency is going to generate returns indefinitely into the future. It's clear that people are just buying it because they think they can sell it to someone else at a higher price in the future. There's no fundamentals. Now, that doesn't mean necessarily that blockchain doesn't have value, and I think there's a way to regulate the risk associated with crypto and to the consumer protections point that you raise, while still allowing traditional financial services to experiment with blockchain as they are. And I think our existing financial regulatory framework is more than capable of keeping up with the traditional financial system using blockchain. But unbacked crypto assets, there's no there, and we have plenty of history to prove it.